Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome back to the Ask Ralph Show. Let's take a look at our Ask Ralph mailbag again. And just remember, you can submit your questions to Ask Ralph by sending an email to ralph@askralph.com. That's Ralph, R-A-L-P-H, at askralph.com. Now, this question comes from Allison. Allison writes, we filed our taxes online a few days ago, but I was just wondering when to expect my refund. Will someone send me a notice of the direct deposit? Well, Allison, this is a very good question. I get this question a lot. And unfortunately, I am not aware of any notices that are sent out. I know the IRS doesn't send any out. What we tell clients is generally refunds take between 14 and 21 days if there are no issues with your tax return. Now, you have to remember, if you're going to a tax return place or an accountant, that when you sign your documents, the accountant or tax preparer is generally supposed to file those tax returns within a reasonable amount of time. Now, my experience has been that generally the IRS cuts off on Fridays. So if you don't get your refund this Friday and your return was timely filed, it could be in your direct deposit as soon as the following Friday, but there's no guarantees with that. One of the things that I tell my clients is the best way to look into this is to go to www.irs.gov. That's the IRS website. And there's a button there that says, where's my refund? And that is a fantastic resource to use. All you've got to do there is click on that, and they'll ask you a few questions, like your social security number. They'll ask you, what was your filing status and how much were you expecting in your refund? And then they'll give you an idea of whether your return was processed. You can double check and make sure that it was actually filed. And also they'll give you an idea about when to expect your refund. Now, if you are wise, you set this up for direct deposit. That is certainly the quickest way to get your refund back. If you're asking for a check, then you can probably add a few days to that. Now, if you filed state taxes, many of the states have a Where's My Refund button as well. So that's another where you can check and see what's going on. Now, if you find that your information doesn't show up on the IRS Where's My Refund, then you might want to get in touch with the accountant who filed your return. If you did it online, contact their customer service folks and see what's going on with your refund. Now, here's a question from Fred. Fred writes, my uncle passed away last summer and I received some money from his estate. I think I received life insurance money, but I'm also remember having to sign something about getting money from his IRA. I'm working on getting my documents together for the accountant. What do I need to bring? Fred, this is a very, very common question. It's a question that we get quite a bit. And really what it comes down to is the character of the money that you received. Now, that's a fancy way of saying, what was it that you received? Now, in particular, let's say, for example, that you received, you mentioned here life insurance. Generally, life insurance is not an income source to the person who receives it. So if your uncle left you as the beneficiary for his life insurance policy, then any money you receive from the life insurance company is not taxable income to you. That's a general rule. Now, where it gets complicated is you mentioned something about an IRA here. Now, IRAs or pension plans, 401ks, those type of things are what we call pre-tax money. Now, since no tax has ever been paid on these monies, when you inherit this, you may have to pay tax on those things, and there's specific rules about that, and that's why you were asked these questions, because there are rules about, do you have to take it all out in what they call a lump sum, or can you roll it over into something called an inherited IRA where you can take the money over a certain period of time? Now, another thing that you didn't mention in here, but I get this question a lot, is what if you're left property, or what if you're left some sort of investment? And we get into a whole discussion of something called stepped up basis. And I'll take a second or two to talk about that. What stepped up basis basically means, and the best example I can give you, let's say your uncle died and he had stock in the DuPont company, local business. And let's say he had 1,000 shares of DuPont stock, and I don't know what that's selling for today, but whatever the value of that DuPont stock was on the day that your uncle passed away is what will be your, quote, basis in that stock moving forward. So let's just assume that that stock was selling for $10 a share. So you have 1,000 shares at $10 a share. So your basis in that stock, is is $10,000. Now, let's say that you hold on to that stock and, for a year or so, and then you go to sell it. Well, the only income you would have would be whatever the appreciation in value is of that stock. So let's say now that stock that was $10 a share on the day that your uncle passed is now $20 a share. Well, then you'd have $10 per share of what we would call capital gain. So you would pay tax on that. Now, if on the other hand, let's say the stock value went down. Let's say, on the day that you inherited, it was worth $10 a share, but now all of a sudden there's been a downturn and it's only worth $8 a share. Then you would actually have a $2 per share capital loss. Now, one of the things that becomes a bump in the road here is, let's say you inherit real property. What I mean by that is, let's say your uncle had a house at the beach and, he said, Fred, when I die, I want you to have this house at the beach. And so you inherit this property. Now, one of the pitfalls I see is someone needs to value that property on the date that your uncle passed away. Now, obviously that doesn't mean, while you're still on your way to the funeral home that you're calling a real estate person to do an inspection or an appraisal, but you do want to try to get something done pretty quickly so that you have an appraisal in your hand that says, on or about the time that my uncle passed away, the value of the property was $200,000. And then you would have a capital gain or capital loss depending upon the sales price if you eventually sell it. Now, the next question comes from Barbara in Greenville. I've been told that since I retired at age 62, my Social Security may be taxable, but my friend Helen said that she did the same thing and she doesn't have to pay tax on her Social Security. I just started a little part-time job and I have my state pension, so I was wondering how this would impact my taxes. Please help. Well, you know what, Barbara? Everyone's situation is different, and I appreciate Helen giving you some information, but Helen's situation may be different than yours. Now, there's a couple things to talk about here. We got a few minutes left, but if you take your Social Security age 62, which is considered not before full retirement age, you really have two considerations. Consideration one is if you make over a certain amount, and I want to say the number's around $14,000 or $15,000 this year, then you may have to pay back some of those Social Security benefits. The second part of that is, regardless of whether you have to pay any back or not, you may have to pay tax on any earnings you have if your earnings other than Social Security are greater than a certain amount. So what you're telling me here is basically two pitfalls, and that is you could have a part-time job and don't know how much money you're making there, but if you're making over that earnings limit I talked about, you may have to pay back some of your Social Security benefits. And when we add your W-2 or part-time job earnings and your pension, you may end up paying tax on this as well. This is why a lot of my clients will wait till full retirement age to retire. Now, you're not going to get around the income tax on your Social Security. Basically, if you make over a certain amount, potentially 85% of your Social Security income might be taxable, but you won't have any loss of benefits or loss of Social Security earnings once you reach that full retirement age. So I hope this answers your question. And like I said, I encourage everyone to send your questions to Ralph at AskRalph.com, and we'll be happy to answer those and provide you with great information moving forward.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.